Thanks for joining us today on Market Column. Morella Fernandez. Christine Poole is our guest on the show, Co-Chief Investment Officer at Davis Rea. She'll be taking your questions on North American large caps. Here's how to reach us. Call us toll free at 1-855-326-6266. You can also send an email, marketcall@bnnbloomberg.ca. Christine, good to see you.
Nice to be here, Morella.
I know there are a lot of tailwinds that you've spoken of for the economy this year and for the market this year. I'm wondering how much a headwind you see that dispute that's happening right now between the U.S. and Europe.
Well, definitely, Morella. I think that the largest headwind will continue to be geopolitics. And, you've got Trump saying this about, putting on tariffs for countries who are, standing up against his desire to take over Greenland. But he has said that. We don't know if he actually can do that. It could be, is that even an illegal option for him to do that? We know his tariffs that he put in place last April is being disputed in the courts. We should be getting a Supreme Court ruling, I hear, sometime this week. I guess either way, if they rule it illegal, he likely will have some sort of backstop action.
We shouldn't assume they'll disappear.
Yeah.
Yes.
But once again, he says these things. It creates volatility. We're seeing that in the European markets. Toronto's basically flat, I guess, because gold and silver are doing well. But that is the largest headwind. But we also know, looking back the past year, that Trump is very aware of the U.S. economy. He cares about affordability in the country. He cares about the stock market. So we'll see how it plays out. It's very difficult to actually predict how it's going to end up.
Okay. You saw the carve-out for CUSMA as a benefit, as most Canadians did last year, which meant a lot of what went to the U.S. was not going to get hit by a tariff.
Correct.
It's up for a review this year. How do you perceive it this year?
Well, there's going to be a lot of headlines about this. And I think they're going to start negotiations or start talking in the summer. So I expect that we're going to see a lot of back and forth. I do think the agreement is very vital for our trade with Mexico and the United States. And, Trump has made some comments that he doesn't think it's that relevant, but there are constituents and corporations and sectors in his country who also want the agreement to stay in place, such as the car manufacturers. And they're a big component of the U.S. economy, and they employ a lot of people. So I'm hopeful that they can iron something out and come out with some sort of agreeable term.
Okay. What else do you see as providing or affecting the Canadian market this year in a positive way?
Well, and positively, I think it's really fiscal stimulus. We've seen Mr. Carney want to encourage infrastructure, open up trade lanes with other countries. You saw over the weekend he announced, decreasing tariffs on electric vehicles from China. In exchange, they're going to decrease some tariffs on our goods. And so I think, and a lot of governments are putting that in place. There, in terms of defense spending as well. So all of these things will hopefully stimulate some business activity within Canada, and make Canada a more favorable place to invest.
And all of that you think will be on a positive track for this year?
Yes.
Got it. Okay, let's take a quick break. We'll line up the first phone calls for Christine Poole of Davis Rea. Again, she's taking your questions on North American large caps. Here's the number to reach us and the email address as well. We're back in a moment. Welcome back to the show. We're going to start with an email from Tony. He wants Christine's opinion on Honeywell, H-O-N, please. What's your opinion on Honeywell?
Yeah, so Honeywell, I consider it kind of a diversified industrial conglomerate based out of the United States. Now, the company did announce back in February of last year that they were going to spin out their, I think their aerospace division. It's aerospace and automation. So what's going to be left primarily is going to be automation in terms of commercial buildings, properties, et cetera. We don't own the stock. The stock price has kind of lagged some of their other industrial names because some of their businesses are very short cycle, meaning they're more economically sensitive. And the industrial economy has been somewhat weak the last few years. It's a high quality industrial company. And I think their automation side looks interesting. So I think for myself, my preference is to wait for the spin to actually happen. It's scheduled to occur in the back half of this year. Honeywell traditionally has also grown through M&A, and I think one of the overhangs on the stock, because the stock price has been kind of up and down, is that while this we're waiting for the spin-off to happen, the M&A strategy might be put on hold. So they probably won't do a lot of transactions until they get the spin executed. So once again, I think I'm going to wait until the spin happens and then reassess the growth outlook for both sides of the business and decide if we want to make an investment in one or the others.
Typically, when a company announces a split like that, does the stock price take a hit?
Temporarily, maybe before the actual spin, because everything kind of not pauses, but management is focused on getting this executed. And then post the spin, and I think of other companies that have done this, like United Technologies, UTX, the standalone companies can be more focused on growing the individual businesses, focus on productivity improvements. And typically, sometimes as a standalone entity, they tend to do better than being inside a larger conglomerate holding.
Okay. Let's talk to our next caller. John's on the line in London with a question. Hi, John.
Thank you, Marilla. Hello, Christine.
Hi.
Speaking of spin-outs, I'm a long-time holder of GE, so I own the three components.
Right.
Vernova has done very well, but it's probably a little rich on the valuation. The healthcare stock hasn't done much. Aerospace has done very well, and I think it fits with the Trump agenda and what's happening in the world. What do you think of GE Aerospace here for an ad? I've done very well with the stock. Thanks very much.
Okay, thank you for the question. What do you think of GE Aerospace specifically?
Well, I like the aerospace sector. We have another holding that participates in that, but I think it's a great long-term hold.
Do you like it more recently?
Pardon me?
Do you like it more recently? Like, are you liking it
more aerospace?
Recently? Yes, in the last year.
No, I think we've liked that sector for a while because I think aerospace, air travel in particular, it's a growing industry. People, as you know, we have people all around the world that are traveling, and that continues. And as well, the way the aerospace sector is made up, and GE makes engines, you have the equipment that people buy, the engines, and then they have the aftermarket, which is the service component, the maintenance and service component, which is very reoccurring and higher margins. So I like that kind of model where you have, you actually, yes, you sell the original equipment, but you have that lucrative maintenance contract tied to it. So for GE Aerospace, and the stock's done very well. I think most aerospace stocks have. I would continue to hold it, and probably on a pullback, you could add to the position.
Okay. Let's go back to the phone lines. And Chris is on the line, and he's in Delta, BC. Hi, Chris.
Oh, hello, Marilla and Christine. Christine, always great to have you on the show. I think you're probably the guest I look forward to the most appearing. If I could please have your opinion on CN Rail. I know you've spoken on it many times in the past, and just like to hear your current thoughts and whether you'd be buying it today with new money. Thank you, and have a wonderful rest of the week.
Okay, thank you for the question. CN Rail, like a lot of transportation, beaten down last year.
Yes.
Do you like where it is?
We do like CN Rail, and I think it was one of my top picks the last time I was on a couple months ago, and we'd be buying it here. The railroad has lagged, arguably its peer group as well. And really that's been a function of a few things. As you said, Marilla, economic growth in Canada was softer probably than what the company thought earlier on in the beginning of the year. That caused them, and I'm thinking of 2024 actually, and they had some labor disruptions, port disruptions that impacted their volumes. And so the company had to reduce guidance for 2024. 2025 came in, and they were investing a lot of money into their network because when the new CEO came in, they arguably were needed under capacity. They need more capacity, so they spent that money. They're prepared. They're ready now to. If volumes pick up, there's a lot of leverage, and that will fall to the bottom line. So I think going forward, in terms of the valuation as well, the stock is trading near its trough multiple, discount to its peer group, which, historically, CN has usually been trading near the top end. So we think it's very attractively valued here. And going forward, as we talked earlier about the fiscal stimulus, maybe decreased tariffs on certain agricultural products that Mr. Carney's negotiated, that will help volumes as well. And at this point, I think the Canadian economy, it remains relatively soft. I think there is room for improvement, and that will generally benefit, I think, the transportation and the rail sector.
So you'd put new money in, I guess?
I would, yes.
Okay. Let's do another email then from Cece. Cece says, does the guest have any thoughts on TD Bank? We'll pull up TD in just a second. TD did well last year.
Yeah, it was actually the best performing Canadian bank, I think, Marilla, up over 60%, 65%. It is one of the three banks we own in our client portfolios. The bank, as we know, back in October of 24, they revealed all their anti-money laundering issues in the United States. Stock price pulled back quite dramatically. The regulator in the U.S. put an asset cap, meaning they couldn't grow their assets up to a certain level in the U.S. So the company responded by they sold some non-core loans they didn't want. They sold some non-core businesses so they could create more space to grow with their customers there. And they refocused on their Canadian operations. And they have a very low-cost deposit base to fund their loan growth. And so look at the stock. The valuation back in October was trading at a 9.5 times price to earnings multiple, which is very, very low for TD. And now it's trading at 14 times. So obviously the company has executed. They were actually able to grow their earnings last year by about 6%. They're buying back stock. We still continue to hold it. We have trimmed back a little bit because it went above our target weight and because it's done so well. And in terms of valuation, at 14 times, the group as a whole, Canadian banks, are trading probably at the upper end of its range. So definitely TD is not as inexpensive as it was a year ago. But we still think that they're very well positioned in Canada to grow. They can grow the capital markets in the United States. So we continue to hold it.
Okay. Let's take a quick break. We will line up some more of your phone calls for Christine Poole of Davis Rea. Again, taking your questions on North American large caps. Back in a moment. Welcome back. Thanks for joining us. Let us go to the phone lines and talk to our next caller. John is on the line, I think, in Milford. Hi, John.
Hello. I would like your thoughts, Christine, on National Bank. I own all the banks. I've owned them all for like 30 years probably, and I've doubled and tripled National Bank. I paid $39 for it. Now, do you find that they're all getting pretty stretched? But I'd like your thought on National Bank. Thank you very much.
Okay,
Bye.
Thank you for the question. What is your metric for being stretched? Where do you start thinking it's too overvalued?
Well, I think I mentioned before, Morel, the Canadian banking group did very well last year. I think they were the second sector behind materials. All the banks were up quite a bit. And so the valuation multiples, as I said before, are getting towards the upper end of where they historically trade, price to earnings as well as price to book value. But having said that, all the banks, the big six, they operate in an oligopoly. They're very well run, highly regulated, so it's very difficult sometimes for them to actually get into financial difficulty. We saw that in the last financial crisis. So it's a kind of a go-to area for Canadian investors in particular to invest in because they offer attractive dividend yields as well, ranging from 3 to 4.5%. And the banks, as we know, they increase their dividends annually. They only paused it in the financial crisis. They never cut their dividends, so that's a very attractive attribute. In terms of National Bank, the stock historically has, I think, done well. It's more Quebec focused, but then they bought Canadian Western Bank last year, so that actually broadens their geographic scope now to Western Canada. It's a large acquisition. They have to integrate that in. I think it's the largest they've ever done. I think you could hold it, continue to hold it as a long-term hold. There's nothing wrong with that. It's not one of the banks we own just because we just decide to choose among the big six. We don't hold them all. We just kind of choose, whatever let's say 2 or 3 to hold within our client portfolios. But there's, I think National is a very attractive long-term income stock, probably. Yeah.
Okay, let's move on to our next caller, another John in Toronto. Hi, John.
Yeah, hi, Morella. Excellent, Morella. I always tell you excellent.
Thank you.
And a shout out to your front desk there, just a great lady there. Christine, I'm going to read my question here because I'm surprised you took the call and I want to get through it. Everybody always asks about stocks, but no questions on the strength or structure of the U.S. market. Is a lot of that strength just coming from the stimulus, which is debt, that the U.S. is adding $2 more trillion this year? Gives a rosy picture to company earnings and outlook for stocks. Even tax breaks they get this year boost markets, but it should go to pay debt. When countries stop buying U.S. bonds or treasuries, is the stock market not looking at a huge downside? Am I too negative? And I give you full credit for taking my call, Christine. Thanks.
Yeah. Okay. So macro question on the debt of the U.S. and the stimulus and whether it's the right kind of stimulus. I guess, for the market.
That's the big question because we know debt to GDP in the U.S. has been increasing. I think it's close to 6 to 7% of debt to GDP. And all government debt around the world for most countries is going up. not to the extent maybe as in the U.S. We know in Canada as well, our debt levels will increase hopefully temporarily that's part of fiscal stimulus because you're investing in the economy to get it going. And the eventual outcome, what governments want is that businesses start investing, they start producing more profits, and they get taxed. So eventually you get it back through higher tax payments to the government, which they should use to pay down debt. Now, we know President Trump, he passed that big, beautiful tax act last year, which is going to cut taxes and give incentives for companies to invest right off R&D and depreciation. And so, yeah, I mean, in the end, hopefully the economy does improve and you get some of that back. It is a concern longer term. It does provide, fiscal stimulus does provide short-term positive for the stock market and for corporate profits. And I guess longer term, the bond market, until we actually start seeing treasury yields, and I'm talking U.S. 10-year treasury yields, start to go up. If they start going up, right now they're about 4.2%. They've been relatively stable for the last, couple of years. If the yields start going up, then that's concerning. So that's something to watch for. That means that global bond investors, U.S. bond investors, are not buying to the extent. So, so prices are going down and yields are going up. And when bond yields go up, it's also a headwind for the stock market because it's more expensive for companies to, take out loans, expensive for consumers, et cetera. And for income stocks, it's a headwind. So, yeah, for now, I mean, it's something to keep an eye on, obviously. And we just have to see how it plays out, but look at the bond yields and see how they react.
Okay. Let's go to Kevin then. Kevin's on the line. He's in Brantford, Ontario, with a question. Hi, Kevin.
Hello. Thank you for taking my call. Christine, I'm 62 years old, retired. I've got a decent portfolio. I'm not concerned about that aspect of it, but what I'm concerned about is gold prices. Is it too late to start? I wish I would have bought more gold, but I didn't. Is it too late to get into the gold, like a monthly purchase? I'll just hang up and listen to your response. Thank you.
Yeah, I'm sure a lot of people like Kevin have the same question.
Yeah.
Is gold still going to run?
Yeah. And no one knows, right? Yeah. No one knows, Marilla. I don't know. I mean, it's very sentiment driven, and arguably after a lot of strength, then you get these momentum investors and, coming in. And so eventually you might get some sort of sell off. So, typically we don't own gold in our client portfolios because it's very difficult to forecast the movement of the commodity. And then in turn, for the gold producers, a lot of their earnings and cash flow are driven by the commodity price. But, they've had a tremendous run, as your caller noted. I guess, I kind of feel like it's had a huge run. So, maybe, I wouldn't be chasing it if he wants some gold exposure or add to his gold exposure in his portfolio. Wait for some sort of sell-off. It's going to eventually come because it's, right now, it's going up because of what Trump has said over, more recently.
What kind of sell-off would you watch for? I mean, when would be a good time, do you think, to buy some?
I don't know.
Roundabout.
I mean, I would say at least, 10% sell-off at least.
So significant.
Significant, yeah. I think there's a lot of momentum behind it. So personally, we haven't added gold to our portfolios. We try to focus more on companies who are, I guess, more in control of their destiny and have more visibility. We have more visibility in trying to forecast their cash flows and their profit outlook based on the industries they're in. Whereas in gold, like I said, it is very much sentiment driven.
Okay. Let's get to Evelyn. Evelyn's in Lethbridge, Alberta, with a question today. Hi, Evelyn.
Oh, hey. Thanks for taking my call. And I do appreciate Christina's approach. My question is on Pfizer. I've held it off and on. I've been advised that it's good to hold something that pays you in U.S. dollars, but Jim Cramer's interview last week with Albert Bourla, he asked if the dividend was sustainable, which to my mind is a red flag if that's the only question a reporter has to ask you. But some of the glimmers of hope are the oncology assets, and I do recognize some things that are a value investment, you do have to hold over 20 years. I'd appreciate your perspective. Thanks.
Okay. Thank you for the question, Evelyn. So let's talk about Pfizer. I'm just looking at analysts. So it's sort of got 14 buys and 15 holds at this point, one sell.
So Pfizer, they really, their profitability really benefited during COVID with the vaccines, right? So that was and so they over-earned for a couple years. And so ever since we got out of COVID, the company has been trying to find revenues to replace what they lost in the vaccines, because obviously we know that demand dropped dramatically. So and so they've made acquisitions, they're investing in their pipeline, but it's a longer term view. The stock, arguably, when profits surged during COVID, that wasn't sustainable. But as you know, when the stock is at the top like that, no one's really thinking beyond that. And so that's what happened. So the multiple has contracted quite a bit. Does, I think, provide quite an attractive dividend yield. We did look at Pfizer, actually, I want to say maybe a year and a half or 2 years ago when they were coming out of COVID, and we thought maybe there is value here because the stock price dropped so much. But I think we just thought that there wasn't really kind of a near to medium term catalyst to get the stock going. The pipeline investment is going to take a while because it takes years to develop drugs. They obviously are trying to get into the obesity market, but they're working, I think, on a pill form, but their prior efforts did not happen. But they're very diversified. It's a high quality company. I don't expect the stock price will probably do much in the near term, but if the caller is just holding it for dividend yield, she can do that. I don't think they're going to cut the dividend. But you can look for I think a more attractive healthcare name that has a combination of both dividend as well as some growth, more visibility on their growth.
Okay. Let's take a quick break, then we will come back with past picks from Christine. Back in a moment. Welcome back. Time to go through some past picks for Christine Poole. These are from December 16th, 2024. At the time, Alphabet was on her list, GOOGL on the NASDAQ at 196.66 US, up to 330 today, flat, of course, with the market closed at 68% upside and total return of 68%. It was quite a while ago. Yeah. You remember why you liked Alphabet at that time?
Yeah, so that was just over a year ago. And I remember when I recommended it, the stock was somewhat out of favor, the feeling that they had fallen behind in artificial intelligence. Potentially, they would have to break themselves up.
That's right.
For competitive reasons. And then the overhang that with, artificial intelligence, that would take away from their search business, which is what their primary growth is advertising, right, when you're doing search. And so all those things were weighing on the stock. Stock was trading at a very low multiple, which is why we recommended it. And then, fast forward, I was actually placed in September, October when the stock really started to move. They had a very strong third quarter. They also have a cloud business called Google Cloud, which is growing very rapidly, I think growing over 30, close to 35%. So it was a sequential pickup. And then as we all know, the court ruled that they did not have to break themselves up. So that was favorable.
Which was key, yes.
That was key. So that kind of alleviated itself. Meanwhile, their latest, their large language model, which is Gemini, they've had new versions come out, which the latest version was, I think, about a month ago, got very favorable reviews, and it's doing very well. So once again, the sense that they actually are ahead of the game, and it's actually helping their search business. People are not, not using Google search. They're kind of using it because they've embedded AI in that search product when you go on, and it's actually helping people stay on their platform longer. And so their advertising business has not really been hurt by it. It's still growing double digit. YouTube's doing well, which is one of their divisions. Ads on YouTube
does very
is up
well,
50%.
yes.
Yeah, so people are watching YouTube as a TV alternative.
Yes.
Like, it's bizarre. My parents watch YouTube for news and programs, right? So I think all those things before when I recommended it was like underappreciated, and then it kind of everything started clicking for them in the last quarter. So the stock now is up, like you say, 66%, trading at about 30 times forward earnings. We have taken, it's our largest tech holding, so we have taken some profits out from our client portfolios, but we do still keep it as a core tech holding.
Okay. Let's get to your next past pick. Chubb Limited, CB on the New York Stock Exchange, 275.72 at the time, so December 2024, 377 US at now, so 9% upside, 10% total return. This is a company, could they benefit from the build out in the US that is happening, or look at sort of infrastructure plays?
Well, it's a global property and casualty insurer, so I guess if potentially if there's enough new builds, like they would potentially
they might get
do
something
that.
from
Yeah.
that.
But I think Chubb has proven like they're a very effective, competent assessor of risk. Because when they write policies, they charge their customer or clients a premium, and then you pay it up front, and they may or may not have to pay out that policy. It depends what happens, right? If an accident or whatever, something occurs. So they're very good at assessing that. And when I say that, their combined ratio, Marilla, is consistently under 90%, meaning that what they charge in premiums more than pays for any claims they have to pay out, as well as their operating costs. So they're efficient operator as well, compared to their peers where the operating combined ratio is closer to 95%. So they're very profitable that way. And then they use those premiums to invest in a portfolio of investments. For Chubb, it's primarily investment-grade bonds, so they get a return on those funds until if and when they have to actually pay out the claims. So they're very good at this. Global, lots of vertical markets. Highly specialized policies they write for high net worth individuals, unique circumstances. They have a growing life insurance business in Asia where they feel the population is much younger there, so they see good growth opportunities. Mm-hmm. So I kind of view it as a defensive financial stock. Usually, you renew your policy every year unless they've really done something wrong, but they're very good at client servicing as well. So we continue to hold it.
Okay, let's get to your last pick then. WSP Global on the TSX. At the time, it was 248.53 up to 271.90 today, so 9% upside, 10% total return. I imagine this is one you've held on to.
Yeah, we really like what WSP Global, and we would actually be adding to it here. It's based out of Montreal, but it's a very global in nature. Only about 15% of their revenues are actually from Canada. The company does grow organically and as well as through M&A, mergers and acquisitions. They did a couple of acquisitions in the last year and a half that has really grown their power and energy vertical. Mm-hmm. And their client base is primarily utilities. So they're seeing increased business flow for the increasing demand for power from data centers. Okay. So for now, their latest acquisition was in December, TRC, which was in the power space. And that acquisition actually now brought WSP Global. They're actually the largest engineering, design, and services company in the United States now. We think that all their vertical markets have good growth opportunities. Company has a solid balance sheet. This latest acquisition has elevated their debt levels a bit, but we see it going back to kind of that 1.5 to 2 times EBITDA by the end of this year. There's going to be cost synergies as well as revenue synergies, meaning they can cross-sell business between their divisions. We think it's well positioned. They don't do construction, which is an area that a lot of engineering firms can get into trouble because there's cost overruns. They specifically focus on advisory and design.
Okay, let's take a quick break. Then we'll come back with more phone calls and emails for Christine. We're back in just a moment. Welcome back. Let's go to Cal on the line. He's in Saskatoon with a question. Hi, Cal.
Hello.
Go ahead.
Yes, it's on your thoughts on Algonquin Power, please, Christine.
Sure.
Okay, thank you for the question. We talk a lot about energy stocks with build-out, et cetera. What's your take on Algonquin?
Yeah, so Algonquin, I believe, they ran into difficulties a few years ago. It's not a stock that we own in our client portfolios. And the company got overstretched. I think debt levels were quite elevated. They had to cut their dividend. And then management decided to sell the renewables division, which was actually the part of the business that I liked, because we had owned it many years ago, and then decided to exit the stock when it got into difficulties. So they've sold the renewable operations. And so now I believe it's a 100% regulated utility. So it should be more defensive. And, they're kind of, I think, operated within their means now. But in terms of a utility name, which we consider income stocks, we want visibility in terms of not only an attractive yield, but potential for dividend increases. I'm not sure what the dividend outlook is for Algonquin, if they will be increasing their dividend regularly. I have to double check on that. I think the dividend in place is safe. But I have another utility that's one of my top picks that we prefer, that we've held for a long time, and is one of our core dividend stocks.
Okay. Algonquin looks like it pays 3.96 in its dividend now. Okay. Let's go to Bob on the line in Pickering, Ontario. Hi, Bob.
Hi, how you doing?
Good,
Thanks for taking my call. Mm-hmm. I have a couple questions. Anyways, one of them was, my main was Brookfield Corp, and then also the spinoff of Constellation Software, Lumi. I just got a bit of that, and I'm beginning to wonder about it. Anyways, thanks for taking my call.
Okay, thank you for the question. Let's go to Brookfield Corp and talk about that for a moment.
Yes.
This is the main corporation.
Yes, the parent corp.
Yes.
Yes. So Brookfield, that's Brookfield Asset Management, which is a different company. It's their asset management arm that you have up on the screen.
Okay.
But we do own Brookfield Corp, the parent company, in our client portfolios. We've owned it for a number of years. We continue to like it. It's an alternative asset manager. We think they're very well positioned in that space. It's growing. There's lots of institutions that are looking for that type of investment category. And most of these firms, including Brookfield, is now branching out to the retail arm. So they're offering their products to retail investors as well, indirectly through funds and through a distribution channel. But we think they're well placed. They've got infrastructure, renewables, private equity through Brookfield, another arm they have. So that they've got publicly listed subsidiaries. And then Brookfield Corp also has various, well-paced in terms of the transition to, well, we know decarbonization is kind of out of favor right now, but I do think it's a long-term secular theme. They've been growing their asset base, as I said. They bought a company called Oaktree Capital a few years ago, which does credit, so that kind of broadened their offering, because Brookfield is very strong on the equity side and kind of asset-based holdings. But credit was an area that they were not as strong in terms of presence. So that Oaktree Capital, headed by Howard Marks, is a very well-known and respected firm. So that is actually helping to grow their assets under management as well. So we think they're very well positioned. We like this company as a long-term hold.
Okay, that was Brookfield Corp. Let's go to Mario in Mississauga, Ontario, with his question. Hi, Mario.
Good morning. Good afternoon, Mirella. Thanks for taking my call. My question is about Royal Bank. If Christy can say anything about it, because I make some money already, but still I would like to find out if I can keep it or look for something else. Thank you very much. Have a good day, both of you.
Thank you very much. Sure. Royal Bank, we talked about one of the financials doing very well last year, of course.
They've done well. And Royal Bank is one of our Canadian banks that we own in our client portfolios. It's probably actually our highest weight in terms of amongst the three holdings that we have. And we will continue to hold it. I mean, it has done well. I think we've trimmed it a bit in terms if it's gotten above our target. But, well positioned. They bought HSB Canada a few years ago.
Yes.
And so that's adding to their growth opportunities. They had cost synergies, and now they can cross-sell as well to the HSB clients. We're now Royal Bank clients, so there are opportunities there. I listened to all the bank CEOs. They spoke at a conference in early January, and they're all quite optimistic in terms of the outlook going forward. I mean, yes, USMCA is uncertainty. That's a topic of uncertainty, and geopolitical is once again the highest risk. But in terms of fiscal stimulus, we talked about earlier, encouraging that there's a lot of potential investment opportunities if these efforts come to fruition and we can focus and get these going. When interest rates were a lot higher, Morel, the Canadian banks were putting aside provisions in case the housing market, got into problems. Yes. And we kind of got through that not too badly. And now interest rates, they started cutting them. And so yes, mortgages that are going to renew, let's say this year or next year, payments might be a bit higher than they were 5 years ago, but they're much more manageable. Nowhere where they would have been if they had to renew, let's say 2 years ago when interest rates were much higher. So the interest rate environment is more friendly, I guess. And once again, these banks continue to increase their dividends. They usually increase kind of in that mid-single digit range. Payout ratios are very reasonable at about 45% of earnings. So I would continue to hold Royal.
Okay. Let's go to an email that from Hillary. She says, good morning, Christine. Please give me your opinion on CGI. It doesn't seem to be able to return to its previous levels. Do you think it could go higher from here? Thank you for that. And again, that was from Hillary. She's in Vancouver.
Sure.
Here's CGI. As we look at the chart, it has trended quite down over the past year. What are your thoughts?
So CGI, we do hold this name. We've held it since, I'm going to say, we originally started buying the stock probably in 2011. It's a long-term hold. And over the long term, it's done very well. So this company is a consulting and outsourcing firm. So half is consulting services, and then the other half is long-term outsourcing contracts that companies will hire them and maybe outsource their back office to decrease costs. Will grow, does have organic growth, but it also grows through merger M&A, buying companies, and it's very disciplined when they buy companies. They have very kind of strong financial guardrails that they adhere to. So the reason for this more recent pullback, I think, is because with artificial intelligence, the perception that they may be decreased need for some of their services because companies can maybe do the analytical work themselves and require less of their services. Now, CGI, I think, companies want to implement artificial intelligence in their business processes. We're in the very early stages of that. And I do think that they will need very highly technical, skilled people to do that. And so there is a role for CGI to do that.
So those contracts could come through CGI.
Yes. And as well, they're also implementing AI into their own internal operations to make it more efficient, right? And to make it more effective. And so all companies are always looking to decrease costs. And so I think in terms of their outsourcing business, that will still be a benefit for them. And they can introduce automation into doing, whatever, like some of those businesses, onboarding businesses and back office operations. So for now, it's pulled back. It's trading at a very attractive valuation. And the company had noted in prior years that for their acquisition strategy, the prices they were having to pay were very high. And so they were kind of backed off on that. But now they feel that the pricing has actually gotten more attractive. So I would expect that their M&A strategy will start to pick up, and that will be beneficial for longer term growth.
Okay. Let's take a quick break. We will have more questions lined up for Christine when we come back. Welcome back. We have Ernie on the line. He's in NIMO-BC, and he's got a question today for Christine Poole. Hi, Ernie.
Hi. My question is on Emera. I have two things about this. One is it a good idea to enter at this point? It seems a bit high to get long-term growth and dividend. The other part of the question is it a good idea to invest in utilities that are heavily involved in the U.S.? I would like your opinion. Thank you.
Interesting question. What do you think of Emera? Because the U.S. part, I'd love to hear your response to.
Yeah, no, Emera, so, a lot of the growth Emera is experiencing is actually coming from the U.S. because they bought a Florida utility a few years back. So, it's not a utility we own. As I said, Marilla, there's one that I'm going to talk about later on. But it's a I think it's an income stock. It's fine. Like you could, have a position in it. The utilities have done well, but as a function, as an offshoot, and that kind of relates to his question about the U.S. because we know that the demand for power from data centers has actually been very beneficial for electric utilities because they transmit and transmit the power and supply the power, right? And so that means that it's good because they can spend their capital, it's regulated, so they spend and they get a allowed rate of return on what they spend. So that's how they grow their earnings. So I think the the Canadian utilities have done well, but the American utility stocks have really done well because they're seeing that direct impact of the demand for power. And some of the hyperscalers, the cloud providers, have contracted directly with utilities, like nuclear utilities, like we'll fund, we'll guarantee,
yes.
yeah, exactly. We'll do a long-term, take or pay contract so that they have visibility that if they invest, then there's a customer at the end to take that power off, the offtake. So, yes, there is. I think he's probably alluding to maybe the political uncertainty and volatility that we're seeing in the U.S. But in the end, with the data center and the reshoring, if companies come back to the United States, which is one thing that Trump wants companies to build factories, come back and build factories in the U.S. Once again, demand for power, right? And so indirectly, it does benefit the utilities. Obviously, we have to be aware of valuations. They're probably nowhere near as cheap as they were a couple of years ago. But you want to find a utility that is well positioned, and as I said before, it pays your dividend, and that you think can increase their dividend annually.
Okay, let's take another quick break. We will have a look at new picks from Christine when we come back. Join us tomorrow for Market Call. Nick Mersch will be on the show, portfolio manager at Purpose Investments. He'll take your questions on technology stock. That is tomorrow. Time now for new top picks from Christine. We're going to start with Microsoft. MSFT on the NASDAQ, one of the Mag 7, and clearly you like the stock. You already own it, and what do you like about it looking down?
Yeah, so in a way, the stock has kind of been not out of favor, but the focus, as we talked earlier about, has all been on Alphabet. And, so the stock price has probably lagged in terms of appreciation amongst that Mag 7 group, and definitely behind Alphabet. So we think Microsoft, we all know the name, global software company, and a proven track record, Merla, of innovating and adapting as technology evolves. Like when the company was first founded back in, I think, 1975, it was just an operating system providing, Excel, Word, right? And then they kind of evolved. They bought LinkedIn, which is now like a professional network platform. Probably everyone's on there. It's also becoming almost like a social network platform. They invested in OpenAI back in 2019. So they had the foresight, I guess, to know that AI was coming, artificial intelligence. They've transitioned, I talked about those office productivity tools, large installed base. Before, way back then, when, like years ago, you just bought a license, and then you may or may not want to buy a new license. But now they've transitioned to a recurring revenue stream where you pay a monthly subscription, which is nice because you just pay that. And
it's easier on the customer, I think.
Exactly, and it gets updated. And for Microsoft, everyone is updating their operating system and those products. So they have this installed base of suites that they can package together. So a very strong competitive moat. They're in they're a hyperscaler, meaning they have a public cloud business, Azure, which is growing very strong. I think up 35-40%. Big backlog. Yes, they are increasing their capex along with all the other big tech companies because they see the demand that's out there. But Microsoft is also a very profitable company. Operating margins are like over 40%. So they are funding this with internally generated cash flow. So I do think that I take some comfort that if they see demand soften or not be as strong, they can pull back and that cash flow just, goes back within the company.
They're not taking on the debt.
Exactly. Yeah.
Okay. Let's get to your next pick, Visa on the New York Stock Exchange. We were talking about how much some of these stocks have taken a hit from the suggestion by Donald Trump that they cap the interest rates, but you like Visa.
Yeah, so Visa, we've owned it for a number of years. It's obviously the largest operator of a global payment network. And the pullback, you mentioned the capping the interest rates for credit cards. That was really for the credit card issuers, so it's really the banks. It doesn't really impact Visa. But as well, Trump kind of mentioned that, it's the Credit Card Competition Act. He wanted all the major banks that to allow their credit card transactions to occur on at least two networks, and one not being Visa or MasterCard. So meaning he wanted it to be open up competition. Now, there's four payment networks in place right now. There's Visa, MasterCard, American Express, and Discover, which is owned by Capital One. And arguably, Visa has the largest global network. It's the largest in terms of transactions processed. U.S. credit volumes represent about 20% of global volumes altogether. So this act that Trump alluded to is not in law. It has to be passed by Congress. So it's nothing has been mandated. And I do think that if it gets into place, it's very manageable for Visa. It might impact their top line revenues by a couple percent, but their operations is very scalable. They can cut back on expenses. They can cut back on consumer rewards. It's a very, they generate a lot of free cash flow, so I think it's very manageable. The stock pulled back about 6% on that. So I think it's actually a very attractive entry point.
Okay, 328 at 30 where it is today. Let's get to your next pick, Fortis.
Yes.
On the TSX, where you talked about during the show having a utility pick. This is it.
Yeah.
What do you like about Fortis?
Yeah, so this is our core utility holding. It's an income stock. We consider it income stock. Gives you a yield of about 3.5%. Fortis has increased their dividend for 50 consecutive years. So once I talked about the visibility in their cash flow, which supports the ability to grow their dividends annually. So we like that aspect. Over 60% of their earnings do come from the United States. They are in regions where data center build is occurring. For example, in Arizona, and they actually have a contract there to supply power to a data center with the potential to increase further out in the years. And so, they're just very well positioned. They're growing their capital spending plan, which supports their ability to increase their dividends. They've actually guided that they can increase their dividend 4 to 6% to 2030. So that's how visible and defensive their cash flows are. Operations are 100% regulated, investment grade. And so this is a company that we think it's a great long-term hold for an income stock.
And you'd put new money in now?
I would, yes.
Okay, because I was going to say, we've seen that run up, so sometimes we wonder whether to put new money in there. Okay, Christine, thanks very much for coming in. It's good to see you.
Okay.
And thank you for joining us today here on Market Call. We'll see you back here again tomorrow.